All right, let's cut straight to it. $1 million, 1,000,000, seven figures, the kind of money that makes you do a double take when you see it in your bank account, assuming you're not already swimming in cash like Scrooge McDuck, which, let's be honest, most of us aren't. But here's the thing about $1 million in today's world. It's simultaneously a life-changing amount of money and somehow not quite enough to retire on a private island and sip margaritas for the rest of your days. Wild, right? Your grandparents could have bought half a city with that. You might be able to afford a decent house in a major city. Maybe, if you're lucky, and the market's good, and you sacrifice your firstborn to the real estate gods. So what can you actually do with $1 million? That's what we're here to find out. And I'm not just talking about the boring financial advisor answer of invest it in a diversified portfolio of index funds. I mean, yeah, we'll cover that, because I'm not a complete idiot, but we're also going to explore the wild, the practical, the absurd, and everything in between. We're going to look at investments that could turn your million into 10 million. We're going to explore experiences that money can buy. We're going to talk about the stuff that'll make you happy, the stuff that'll make you rich, and the stuff that'll make you question every financial decision you've ever made. By the end of this video, you'll know exactly what $1 million can get you in 2024, and more importantly, you'll understand the strategy behind making that money work for you instead of just sitting there looking pretty in your bank account. So buckle up, because we're about to take a deep dive into the world of seven-figure possibilities. And who knows, maybe you'll walk away with a plan for when you finally hit that $1 million mark. Or maybe you'll just realize you need to adjust your expectations. Either way, it's going to be a ride. Let's get into it. Part 1. The Real Estate Game. Chapter 1. Your dream home, or is it? So you've got $1 million burning a hole in your pocket, and the first thought that probably pops into your head is, I'm buying a house. And look, I get it. There's something deeply satisfying about owning property, having your own space, not having to deal with landlords who take 3 weeks to fix a leaky faucet. But here's where it gets interesting. Can you actually buy your dream home with $1 million? Well, that depends entirely on where you're dreaming. If your dream is a modest 3-bedroom house in San Francisco, congratulations, you can't afford it. The median home price there is pushing past $1.3 million. You're about $300,000 short. And that's before we talk about the bidding war you'll inevitably get into with some tech bro who just cashed out his stock options. Want a nice place in Manhattan? Ha ha ha. Cute. $1 million might get you a 1-bedroom apartment with a view of another building's brick wall, and you'll still feel like you got a deal. But here's the plot twist. Move to somewhere like Cleveland, Ohio, and suddenly you're a real estate mogul. The median home price there is around $80,000. You could buy 12 houses with your $1 million. 12! You could become a landlord, start a rental empire, and actually make your money work for you instead of just dumping it all into one overpriced property. Or let's say you want to stay somewhere nice but reasonable. Austin, Texas. You can get a pretty sweet house for around $500,000. That leaves you with another $500,000 to invest, furnish the place, or, eat food and pay utilities. The point is this: real estate is all about location, location, location. Your $1 million could get you a mansion in Mississippi or a closet in California. Choose wisely. And here's something most people don't think about. When you buy a house, you're not just paying the purchase price. There's property taxes, which in Texas can be brutal, at around 1.8% of your home's value annually. There's maintenance, which experts say you should budget about 1 to 4% of your home's value per year. There's insurance, HOA fees if you're unlucky enough to live somewhere with a homeowners association, and about $1 million other costs that add up faster than you can say money pit. So if you drop your entire $1 million on a house, you better have another income stream to cover all those ongoing costs. Otherwise, you'll be house rich and cash poor, which is a fancy way of saying you own a nice house, but you're eating ramen noodles for dinner. Chapter 2. The Rental Property Empire. Now, if you're smart about it, you don't just buy one property with your $1 million. You build a portfolio. Let's run the numbers on a realistic scenario. Say you use your $1 million to put down payments on multiple properties instead of buying one outright. With a typical 20% down payment, you could potentially control up to $5 million worth of real estate. $5 million. That's the magic of leverage, baby. Let's say you buy 5 properties at $200,000 each in a decent market. You put down $40,000 on each property, which uses up your $200,000. We'll save the rest for reserves, repairs, and those inevitable oh crap moments. You finance the rest with mortgages. Now, each property needs to generate enough rental income to cover the mortgage, property taxes, insurance, maintenance, and vacancies, with hopefully some cash flow left over. In many markets, a $200,000 property might rent for around $1,500 to $2,000 per month. Let's be conservative and say your mortgage payment is $1,000, property taxes and insurance are $300, maintenance and vacancy reserves are $200. That's $1,500 in expenses. If you're renting it for $1,800, you're cash flowing $300 per month per property. Times 5 properties, that's $1,500 a month in passive income. Not bad, but here's where it gets really interesting. Your tenants are paying down your mortgages. Over time, you're building equity in 5 properties instead of 1. And if those properties appreciate even just 3% per year, you're looking at significant wealth accumulation over a decade or two. Plus, there are tax benefits, depreciation, mortgage interest deductions, expense write-offs. Your accountant will be so happy they might actually smile, and if you've ever met an accountant, you know that's rare. Of course, being a landlord isn't all sunshine and passive income. There are 3 a.m. phone calls about broken water heaters. There are tenants who decide to stop paying rent, and suddenly you're learning way more about eviction laws than you ever wanted to know. There are surprise expenses like a roof that decides to give up the ghost right before winter. This is why a lot of smart investors use property management companies. They'll typically charge 8 to 10% of the monthly rent to handle all the day-to-day headaches. So in our example, that $1,800 monthly rent becomes $1,620 after the management fee, and your cash flow drops to $120 per property or $600 total per month. Still, $600 a month in truly passive income while building long-term wealth through equity and appreciation? Not too shabby for letting someone else deal with the toilet emergencies. Chapter 3. The House Flipping Fantasy. Alright, so you've watched approximately 10,000 hours of HGTV and you're convinced you're the next house flipping guru. You're going to buy distressed properties, renovate them with your impeccable taste and surprisingly knowledgeable contractor connections, and sell them for massive profits. Can you do this with $1 million? Absolutely. Should you? Well, that's a different question. Here's the reality of house flipping. It's a job, not passive income. It's also risky as hell if you don't know what you're doing. Let's break down a typical flip scenario. You find a distressed property for $150,000 that needs significant work, but could sell for $250,000 after renovations. You budget $50,000 for renovations, so you're all in at $200,000, and you stand to make $50,000 profit if everything goes according to plan. But here's the catch. Things never go according to plan. First, your contractor discovers that the previous owner's DIY plumbing job is actually a nightmare of code violations and impending disasters. Add $10,000 to fix it properly. Then, permits take 3 months longer than expected because the city inspector is apparently working on island time, even though you're in Kansas. That's 3 extra months of holding costs. Mortgage, insurance, utilities. Add another $5,000. Oh, and that trendy tile you picked out for the bathrooms? It's on back order for 2 months. Your contractor's crew is standing around with their thumbs up their butts, but you're still paying them. Add another $8,000. Suddenly, your $50,000 profit is down to $27,000, and we haven't even talked about the 6% real estate commission when you sell, which on a $250,000 house is $15,000. Now you're at $12,000 profit for 6 months of stress, decision-making, and hoping that nothing else goes wrong. Don't get me wrong, professional house flippers make good money, but they know what they're doing. They have reliable contractor crews. They buy materials at wholesale prices. They can accurately estimate repair costs and timelines. They understand market trends and know when to buy and when to sell. If you're a newbie with $1 million and a dream, you're more likely to lose money than make it. The learning curve is expensive in this business. That said, if you're serious about getting into flipping, here's a smarter approach. Use some of that million to educate yourself first. Take courses, shadow experienced flippers, maybe partner with someone who knows the ropes on your first few deals. Start small with cosmetic renovations before you tackle major structural work. And always, always budget more time and money than you think you'll need. The house flipping gods will test you. With $1 million, you could potentially do 4 to 5 flips simultaneously if you know what you're doing, leveraging financing to maximize your capital efficiency. Professional flippers often aim for a 20% return on investment per flip. If you're doing 5 $200,000 flips with $40,000 profit each, that's $200,000 in profit annually. Not bad if you can pull it off. But remember, this is a full-time job. You're essentially running a business, and it requires skills in project management, budgeting, marketing, sales, and construction knowledge. It's not passive income, it's active hustle. Part 2. The Stock Market and Investment Strategies. Chapter 4. The Boring but Brilliant Index Fund Strategy. Okay, time to talk about the strategy that every financial advisor recommends and every exciting person finds mind-numbingly boring: index funds. But here's the thing: boring works. Boring makes money. Boring doesn't require you to become a landlord or flip houses or do anything except exist and wait. Let's say you take your $1 million and dump it into a simple S&P 500 index fund. Historically, the S&P 500 has returned an average of about 10% annually over the long term. Some years it's up 30%, some years it's down 20%, but over decades it averages around 10%. Now, if we're being realistic, we should account for inflation, which historically averages about 3%. So your real return is closer to 7% after inflation. With a 7% annual return, let's see what happens to your $1 million. After 10 years, $1,967,151. After 20 years, $3,869,684. After 30 years, $7,612,255. That's right. Do absolutely nothing except resist the urge to panic sell during market crashes, and your million could become over $7.5 million in 30 years, just from sitting on your butt and letting compound interest do its thing. Now you might be thinking, but I don't want to wait 30 years. I want to enjoy my money now. Fair point. So let's talk about the 4% rule. The 4% rule is a retirement strategy that says you can withdraw 4% of your portfolio each year without running out of money. It's based on historical data and the idea that your investments will continue to grow even as you're pulling money out. So with your $1 million index fund portfolio, you could withdraw $40,000 per year. That's not exactly quit your job and live in luxury money, but it's a nice supplement to your income. And if you're living somewhere with a low cost of living, it might actually be enough to live on, especially if you have other income sources. The beautiful thing about this strategy is that it requires almost zero effort. You're not dealing with tenants, renovations, market timing, or any of the headaches that come with more active investment strategies. You just set it and forget it. Of course, there are some caveats. The stock market can be volatile in the short term. If you retire and immediately pull out $40,000, then the market crashes 30% in year one, you're in trouble. That's why most advisors recommend a more conservative allocation as you get closer to needing the money, mixing in bonds and other less volatile investments. But for long-term wealth building, index funds are hard to beat. Warren Buffett, one of the greatest investors of all time, literally recommends this strategy for most people. When one of the richest guys in the world is telling you to keep it simple, you should probably listen. Chapter 5. The Active Trading Gamble. But maybe you're not the set it and forget it type. Maybe you fancy yourself a stock picker, a market timer, a trading wizard who can outsmart the masses and generate massive returns. With $1 million, you could absolutely dive into active trading. Day trading, swing trading, options, futures, all that exciting stuff that makes you feel like Jordan Belfort without the criminal charges. Here's the brutal truth. About 90% of active traders lose money. 9 out of 10. Those are Vegas-level odds, except at least in Vegas they're giving you free drinks while you lose your money. The few traders who do make money consistently have spent years developing their skills, learning technical analysis, understanding market psychology, and probably blowing up a few accounts along the way. It's not beginner-friendly, but let's say you're in that magical 10% who actually know what they're doing. Professional day traders aim for returns of 10 to 20% per month. On a $1 million account, that would be $100,000 to $200,000 monthly. Absolutely insane returns if you can pull it off. The problem? The stress is unreal. You're glued to screens all day. Every market movement affects your net worth. One bad trade can wipe out weeks of gains. It's psychologically exhausting. And then there are taxes. If you're actively trading, your gains are taxed as short-term capital gains, which is the same as your ordinary income tax rate. Depending on your tax bracket, that could be 37% federal plus state taxes. Suddenly, those amazing returns get a lot less amazing after Uncle Sam takes his cut. Compare that to long-term capital gains from holding investments for over a year, which max out at 20% federal. The tax difference alone can be the difference between building wealth and just spinning your wheels. If you're dead set on active trading, here's a smarter approach. Take 10% of your million, that's $100,000, and use that as your trading capital. Keep the other $900,000 in boring index funds. This way, if your trading account blows up, and statistically it probably will, you haven't destroyed your entire net worth. You're essentially using 10% of your money to scratch that trading itch while 90% continues to grow safely. Think of it like going to Vegas with a set gambling budget. You wouldn't take your entire life savings to the blackjack table, right? Same principle here. Chapter 6. The Dividend Income Strategy. Now here's a strategy that's kind of a middle ground between the passive index fund approach and the active trading chaos. Dividend investing. The idea is simple. You buy stocks or funds that pay regular dividends, and you live off that dividend income without touching the principal. There are plenty of solid dividend-paying stocks out there. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, these boring, stable companies that have been paying dividends for decades. Some REITs, real estate investment trusts, pay even higher dividend yields, often in the 4 to 8% range. Let's say you build a diversified dividend portfolio with an average yield of 4%. On $1 million, that's $40,000 per year in dividend income. Paid quarterly, that's $10,000 hitting your account every 3 months like clockwork. The beauty of dividend investing is that those dividend payments tend to increase over time. Many dividend aristocrats, companies that have increased their dividends for 25 plus consecutive years, raise their payouts by 5 to 10% annually, so that $40,000 this year could be $44,000 next year, $48,400 the year after, and so on. Plus, you're not selling shares to generate income, so your principal stays intact and hopefully grows over time as the underlying stocks appreciate. It's the closest thing to a money printing machine that's actually legal and realistic. The downside? A 4% yield isn't exactly quit your day job money for most people, especially if you're young and have decades of life ahead of you, and there's always the risk that companies cut their dividends during economic downturns. During the 2020 pandemic, tons of companies that had been paying reliable dividends for years suddenly slashed or eliminated them. This is why diversification is crucial. You don't want all your dividend eggs in one basket or even one sector. Spread it across different industries, different geographies, maybe mix in some dividend-focused ETFs that automatically diversify for you. $1 million dividend portfolio with a 4% yield gives you $40,000 per year. That's $3,333 per month. In many parts of the world, that's a comfortable living. In expensive cities, it's a nice supplement. Either way, it's real passive income that doesn't require you to be a landlord or a full-time trader. Part 3. Business and Entrepreneurship. Chapter 7. Starting your own business. Alright, so you're not content being a passive investor. You've got ideas, you've got ambition, and you want to build something from scratch. With $1 million, you've got some serious capital to start a business. The question is, what kind of business? You could go the traditional route and open a brick-and-mortar business, a restaurant, a retail store, a franchise. These can work, but man, the failure rate is scary. About 50% of small businesses fail within the first 5 years. And restaurants? Even higher failure rates. Let's talk about restaurants specifically, since it's a common dream. With $1 million, you could absolutely open a nice restaurant, lease a space, renovate it, buy equipment, hire staff, market the hell out of it. A mid-tier restaurant might cost $250,000 to $500,000 to open, depending on location and concept. Let's say you spend $400,000 getting it up and running. You've got $600,000 left as a cash cushion, which is good because most restaurants aren't profitable in year one. If you're lucky and skilled and the restaurant gods smile upon you, you might generate $800,000 in annual revenue with a 10% profit margin. That's $80,000 in profit. Not bad, but also not amazing considering the capital investment and the amount of work involved. Running a restaurant is brutal. Long hours, thin margins, staffing nightmares, food costs that fluctuate wildly. But here's the thing. If it works, you can scale. Open a second location, then a third. Suddenly, you're running a restaurant group. That initial $1 million investment could turn into a multi-million-dollar business empire. Or it could all go down in flames when a global pandemic shuts down indoor dining for a year. Fun times. Chapter 8. The Tech Startup Dream. Now, if you want to swing for the fences and potentially turn your million into a billion, tech startups are where it's at. This is the Silicon Valley dream, baby. With $1 million, you could fund the early stages of a software company, a mobile app, a SaaS platform, or whatever the hot tech trend is this week. The beauty of tech businesses is that the overhead can be relatively low compared to physical businesses, and the scalability is insane. Think about it. Once you've built software, distributing it to one customer or 1 million customers costs basically the same. Compare that to a restaurant where serving 1 million customers requires 1 million meals, and you can see why tech is so attractive. Let's say you've got an idea for a B2B SaaS platform that helps companies manage their remote workforce. Revolutionary, right? Okay, maybe not revolutionary, but potentially useful. You'd need to hire developers, or be one yourself, which saves a ton of money, build the product, market it, acquire customers, iterate based on feedback, scale. With $1 million, you could hire a small team of talented developers at market rates for about 18 to 24 months. Let's say you hire 3 senior developers at $150,000 each annually. That's $450,000 per year, or $900,000 for 2 years. Add in some marketing budget, tools and software subscriptions, legal fees and operating expenses, and you're pretty much tapped out. But if your product is good and you execute well, you could potentially raise venture capital after proving the concept with your initial $1 million. VCs love businesses that have already shown traction with their own money. It proves you're serious and you've validated the market. The upside potential is enormous. Instagram was bought by Facebook for $1 billion just 2 years after launching. WhatsApp sold for $19 billion. YouTube went for $1.65 billion. These are outliers, obviously, but they show what's possible in tech. The downside? About 90% of startups fail. You could burn through your entire million and have nothing to show for it except some expensive lessons and a really cool company t-shirt that nobody will ever wear. The smarter play might be to start lean, build a minimum viable product with $100,000, test the market, and only invest more if you're seeing real traction. This way, if your idea flops, you've still got $900,000 to try again or pivot to something else. Chapter 9. Buying an existing business. Here's a strategy that's way less glamorous than starting a tech unicorn, but potentially much more reliable. Buying an existing profitable business. There are thousands of businesses for sale at any given time. The owners are retiring, getting divorced, moving, or just burned out. Many of these businesses are actually making money. They just need new ownership. With $1 million, you could buy a business doing anywhere from $500,000 to $3 million in annual revenue, depending on the industry and profit margins. The typical valuation is somewhere between 2 to 4 times the annual profit, EBITDA, though this varies wildly by industry. Let's say you find a local HVAC company doing $2 million in annual revenue with $400,000 in profit. It's valued at 3 times profit, so $1.2 million. You could negotiate down to $1 million, put down $700,000, and finance the remaining $300,000 through seller financing or an SBA loan. Now you own a business that's generating $400,000 in profit annually. Sure, you'll need to work in or on the business, but you've essentially bought yourself a job that pays $400,000 a year. Not too shabby. The beautiful thing about buying existing businesses is that they come with established customer bases, proven systems, trained employees, and historical financial data. You're not starting from zero and hoping it works. You can literally see the bank statements showing that this thing makes money. Of course, there are risks. Maybe the previous owner was the secret sauce and customers will leave when he does. Maybe the industry is declining. Maybe there are hidden problems that don't show up until you're 3 months into ownership. This is why due diligence is crucial. You need to examine financial statements for at least the past 3 years, customer concentration. If 80% of revenue comes from one client, that's risky. Employee situation, are key people staying or leaving? Market trends, is this industry growing or dying? Legal issues, any pending lawsuits or regulatory problems? Asset condition, is all the equipment about to break? But if you do your homework and buy a solid business, this can be one of the best uses of $1 million. You're buying cash flow, you're buying an asset that could appreciate, and you're buying yourself a livelihood. Plus, there's an exit strategy. If you grow the business over 5 to 10 years, you could potentially sell it for much more than you paid. A business doing $400,000 in profit that you grow to $800,000 in profit could sell for $2.4 million at a 3 times multiple. That's a $1.4 million profit on your original $1 million investment. Plus you made $400,000 to $800,000 annually while you owned it. Chapter 10, the franchise model. If you like the idea of owning a business but you're terrified of starting from scratch, franchises are the middle ground. With $1 million, you could open multiple franchise locations of established brands: McDonald's, Subway, 7-Eleven, whatever. These brands come with name recognition, proven systems, training, and ongoing support. The initial franchise fee varies wildly. A McDonald's franchise can cost $1 to $2.3 million to open, so you'd be tapped out on one location. But something like a Subway franchise might only cost $200,000 to $500,000, meaning you could potentially open 2 or 3 locations with your $1 million. The advantage of franchises is the lower failure rate compared to independent businesses. You're buying into a proven model. The brand has worked out the kinks, they know what works and what doesn't, and they'll teach you their system. The disadvantage is that you're paying for that security. Franchise fees, ongoing royalties, typically 4 to 8% of gross sales, marketing fees, strict operational requirements. You're basically buying yourself a job with training wheels. You'll make money, but you're not getting rich quick. Let's run some numbers on a hypothetical franchise. Say you open a franchise that costs $400,000 total to get started. You use your $1 million to open 2 locations and keep $200,000 as working capital. Each location does $800,000 in annual revenue. After paying yourself a salary, employees, rent, supplies, royalties, and all other expenses, each location nets you $80,000 in profit. 2 locations means $160,000 annual profit. That's decent money, but remember, you're working for it. You're managing employees, dealing with customer complaints, ensuring quality standards are met, handling the day-to-day operations. It's not passive income, it's active business ownership. The smart play with franchises is to start with one, master the system, then scale to multiple locations, and eventually hire managers to run them while you step back into more of an oversight role. Get to 5 to 10 locations, and now you're talking about serious money and the possibility of actually stepping back. Some people build franchise empires this way. They start with one Subway, get good at it, open another, then another, and suddenly they own 20 locations and they're making millions. It's a real path to wealth, just not a fast or easy one. Part 4. Alternative Investments and Assets. Chapter 11. The Cryptocurrency Gamble. Alright, we need to talk about crypto. Love it or hate it, it's become a legitimate asset class that people are throwing serious money into. With $1 million, you could go all in on Bitcoin, Ethereum, or whatever flavor of the month altcoin your cousin's friend swears is going to the moon. Should you? That's a completely different question. Let's look at Bitcoin specifically since it's the most established cryptocurrency. If you had invested $1 million in Bitcoin in early 2020 when it was around $7,000 per coin and sold at the peak in November 2021 when it hit $69,000, you'd have turned that million into almost $10 million. Absolutely insane returns. Of course, if you bought at the peak and held through 2022, you'd have watched it crash to $16,000 and lost over 75% of your money. Fun times. This is the problem with crypto. The volatility is bonkers. Traditional stocks might fluctuate 20 to 30% in a bad year. Crypto can drop 50% in a week and nobody even blinks. It's not for the faint of heart. That said, some smart investors treat crypto as a small portion of their portfolio, maybe 5 to 10% allocated to Bitcoin and Ethereum as a hedge against inflation and traditional financial systems. This way, if crypto does go to the moon, you benefit. If it crashes and burns, you haven't destroyed your entire net worth. So with your $1 million, maybe you put $100,000 into crypto and keep the rest in more traditional investments. If that $100,000 10 times, you've got $1 million crypto portfolio and you're feeling like a genius. If it goes to zero, you've still got $900,000 and a good story about that time you tried to get rich quick. The other play in crypto is not just buying and holding, but actually understanding the technology and investing in projects that are building real solutions. DeFi, decentralized finance, NFT platforms, Web3 infrastructure, there are legitimate technological innovations happening in this space, not just speculative gambling. But here's the thing. To successfully invest in these areas, you need to really understand the technology. You need to read white papers, understand tokenomics, evaluate teams and roadmaps. It's not enough to just throw money at whatever coin is trending on Twitter. And let's talk about the tax situation because it's a nightmare. Every crypto transaction is a taxable event. Buy Bitcoin, swap it for Ethereum, use it to buy an NFT, every step is taxed. You need meticulous records, and the IRS is getting increasingly serious about crypto compliance. Bottom line on crypto, it's high risk, high reward. A small allocation makes sense as a speculative play. Going all in with your $1 million, that's not investing, that's gambling. And while gambling can pay off, it usually doesn't. Chapter 12, Precious Metals and Commodities, Gold, Silver, Platinum. These have been stores of value for thousands of years. Unlike fiat currency, which governments can print infinitely, precious metals have inherent scarcity. With $1 million, you could buy about 530 ounces of gold at current prices around $1,900 per ounce. That's a lot of shiny metal. The case for gold is simple. It's a hedge against inflation and economic uncertainty. When stock markets crash, when currencies devalue, when geopolitical tensions rise, gold tends to hold its value or even increase. The case against gold is equally simple. It doesn't generate any income. It just sits there. You can't collect dividends from gold. You can't rent it out for monthly cash flow. It doesn't grow or compound. You're betting entirely on price appreciation. Historically, gold has returned about 5 to 7% annually over very long time periods. That's decent, but it's not beating the stock market's long-term average of 10%. So why would you buy gold? Diversification and insurance. Having 5 to 10% of your portfolio in precious metals can smooth out volatility when other assets are struggling. During the 2008 financial crisis, while stocks were tanking, gold was rising. During the pandemic panic of 2020, gold hit all-time highs. With your $1 million, you might allocate $100,000 to physical gold and silver, not as your main investment, but as an insurance policy against catastrophic economic events. You can buy physical gold coins or bars and store them in a safe or vault. Or you can buy gold ETFs that track the price of gold without the hassle of physical storage. Both have pros and cons. Physical gold, you actually own it, nobody can hack it, it's yours. But storage is a hassle, insurance costs money, and selling it quickly isn't always easy. Gold ETFs, super liquid, easy to buy and sell, no storage worries. But you don't actually own physical gold, just a financial instrument that tracks its price. In a true economic meltdown scenario, that might matter. Beyond gold, you could also look at other commodities, silver, oil, agricultural products. But these markets are complex and often dominated by institutional traders. Unless you really know what you're doing, stick with the simple stuff, like a gold allocation. Chapter 13, Peer-to-peer lending and alternative credit. Here's an investment category most people don't think about: lending money directly to individuals or small businesses through platforms like Lending Club, Prosper, or various real estate crowdfunding platforms. The idea is simple. You become the bank. People need loans, you provide the capital, they pay you back with interest. Your returns come from those interest payments. With $1 million, you could build a diversified lending portfolio across hundreds or even thousands of individual loans. Most platforms let you invest as little as $25 per loan, so you can spread your risk widely. Returns typically range from 5 to 12% depending on the credit quality of the borrowers. Higher interest rates mean riskier borrowers who are more likely to default. Lower rates mean safer borrowers with better credit. Let's say you aim for a blended return of 7% on your $1 million lending portfolio. That's $70,000 annually, or about $5,833 per month. Not bad for essentially letting your money sit on a platform and collect interest. The risks? Defaults. Even with diversification, some borrowers will stop paying. The platforms typically have historical default rates around 3 to 5%, which is already factored into the advertised returns. But in an economic downturn, those default rates could spike. There's also liquidity risk. Unlike stocks or ETFs that you can sell instantly, peer-to-peer loans are locked up for the duration of the loan term, typically 3 to 5 years. You can't just pull your money out if you suddenly need it. And there's platform risk. If the platform itself goes under, what happens to your loans? Most platforms have contingency plans, but it's still a concern. The smarter approach might be to allocate a portion of your million to peer-to-peer lending as part of a diversified strategy. Maybe $200,000 into P2P lending, generating $14,000 annually, while the rest is in other investments. Real estate crowdfunding is a similar concept, but for property investments. Platforms like Fundrise or Realty Mogul let you invest in real estate projects with as little as $500. You're essentially pooling your money with other investors to fund deals that would normally require institutional capital. Returns typically range from 8 to 12% annually, combining rental income and property appreciation. The minimum investment is low, the diversification potential is high, and you get real estate exposure without the headaches of being a landlord. Of course, these investments are also illiquid, typically 5+ year holds, and come with their own risks, project failures, developer incompetence, market downturns. But as part of a diversified $1 million portfolio, they can make sense. Part 5. Experiences and Lifestyle. Chapter 14. The Ultimate World Travel Experience. Okay, enough about making money. Let's talk about spending it on experiences. With $1 million, you could travel the world in absolutely ridiculous luxury for years. We're talking first-class flights, 5-star hotels, Michelin-starred restaurants, private tours, the whole 9 yards. Let's budget a truly extravagant year of world travel and see what $1 million buys you. First-class round-the-world tickets, $30,000 luxury accommodations, averaging $500 per night, $182,500 fine dining, 3 meals at $100 per day, $109,500, activities, tours, and experiences, $50,000, shopping and souvenirs, $25,000, emergency fund and miscellaneous, $25,000, total, $422,000 for 1 year of living like royalty while traveling the globe. That means you could do this for almost 2.5 years before burning through your million. 2.5 years of waking up in a different country, trying new foods, seeing incredible sights, having adventures, making memories. Or, if you're less extravagant, you could travel comfortably for 5 to 10 years on $1 million, stay in nice but not luxury hotels, fly economy or business class instead of first, eat well but not exclusively at expensive restaurants. Suddenly, that million stretches much further. Digital nomads do this all the time, living in places like Bali, Thailand, Portugal, or Mexico, where the cost of living is low. With $80,000 to $100,000 per year, you can live very comfortably in most of the world while having enough left over to invest and build long-term wealth. Imagine, rent a beautiful apartment in Lisbon for $1,500 per month, eat amazing Portuguese food, explore Europe on weekends, work remotely, or run an online business, and still save money. That's actually doable with $1 million nest egg generating 8 to 10% returns annually. The travel experiences you could have with $1 million are virtually limitless. Safari in Tanzania, Northern Lights in Iceland, scuba diving in the Great Barrier Reef, hiking Machu Picchu, cherry blossoms in Japan, wine tasting in Tuscany, island hopping in Greece, exploring Patagonia, cultural immersion in India. And here's the thing about spending money on experiences versus things. Research consistently shows that experiences make people happier than material possessions. The memories last forever, while that new car or fancy watch loses its luster pretty quickly. Chapter 15. The Car Collection Dream. But speaking of cars, let's talk about what $1 million can buy you in automotive terms. You could go the sensible route and buy one really nice car. A Ferrari F8 Tributo will run you about $280,000. A Lamborghini Huracan is around $200,000. A top-spec Porsche 911 Turbo S is about $210,000. Or you could build a diverse collection. With $1 million, you might buy a Porsche 911 for weekend driving, $120,000. A Tesla Model S Plaid for daily driving, $110,000, a classic 1967 Mustang Resto Mod, $150,000, a Range Rover for winter/utility, $120,000, a vintage Porsche 356 as an investment, $200,000, leftover for maintenance, insurance, and storage, $300,000. Now you've got a 5-car garage covering every need and want, from practical daily driver to weekend fun car to appreciating classic investment. Because here's an interesting thing about certain cars, they can actually appreciate in value. Classic Ferraris, limited edition Porsches, rare muscle cars, these can be legitimate investments that you also get to drive and enjoy. A 1962 Ferrari 250 GTO sold for $48 million in 2018. Obviously, that's an extreme example, but plenty of classic cars have doubled or tripled in value over 10 to 20 years. Your vintage Porsche 356 that you bought for $200,000 could be worth $400,000 in a decade. Of course, there are costs. Insurance on $1 million car collection could run $20,000 to $30,000 annually. Maintenance, especially on exotic cars, is not cheap. Storage in a climate-controlled garage is another expense, and depreciation on newer cars is brutal. That $110,000 Tesla might be worth $60,000 in 3 years. So is spending a significant chunk of your million on cars a smart financial move? Probably not, unless you're buying the right classics as investments. But if cars are your passion, and you're going to buy nice cars anyway, doing it when you have $1 million at least means you can afford it without going into debt. The key is not blowing your entire million on depreciating assets. Buy the cars you want, but make sure the rest of your money is invested and working for you. That way, your investments pay for your car habit rather than eating into your principal. Chapter 16. The Dream Home Makeover. Let's say you already own a home, but it's not quite your dream home. With $1 million, you could transform it into something absolutely spectacular. A full luxury renovation of a 3,000 square foot home could run anywhere from $300,000 to $600,000 depending on the finishes and complexity. We're talking complete kitchen remodel with top-of-the-line appliances, $80,000 to $150,000, master bathroom suite with spa features, $50,000 to $100,000, additional bathrooms renovated, $30,000 to $60,000, new flooring throughout, hardwood tile, $30,000 to $50,000, updated electrical and plumbing systems, $40,000 to $70,000, HVAC system replacement, $15,000 to $30,000, smart home integration, $20,000 to $40,000, outdoor kitchen and entertainment area, $50,000 to $100,000, pool installation, $50,000 to $100,000, landscaping overhaul, $30,000 to $60,000, home theater room, $30,000 to $80,000, wine cellar, $20,000 to $50,000, home gym, $15,000 to $40,000. You could literally check every box on your dream home wish list and still have money left over for furnishing and decorating. The beautiful thing about home renovations is that quality improvements can actually increase your property value. That $400,000 renovation might add $300,000 to $500,000 to your home's value, depending on the market. So you're not just spending money on comfort and enjoyment, you're also building equity. Of course, there's the classic renovation warning. Projects always cost more and take longer than expected. Budget an extra 20% for overruns and surprises. That 3-month kitchen remodel will probably take 6 months, and you'll discover foundation issues, outdated wiring, and asbestos that all need to be addressed. But when it's done, you wake up every day in your dream home. That's worth something that's hard to quantify financially. Chapter 17, the education investment. Here's a use of $1 million that a lot of people don't consider: investing in education and skill development, either for yourself or for your family. You could fund complete college educations for multiple children. The average cost of a 4-year private university in the U.S. is around $200,000 to $300,000, including tuition, room, board, and expenses. With $1 million, you could send 3 kids to great private schools without any student loan debt. The value of graduating debt-free cannot be overstated. The average student loan debt is around $30,000 to $40,000 per student. By funding your kids' education, you're giving them a massive head start in life. They can take career risks, pursue their passions, invest early, and build wealth instead of spending their 20s paying off loans. Or maybe you invest in your own education. With $1 million, you could get an MBA from a top program, $100,000 to $200,000, attend multiple executive education programs, $50,000 to $100,000, hire private coaches and mentors in your field, $50,000 to $100,000, attend conferences and networking events worldwide, $25,000 to $50,000, buy every relevant course, book, and learning resource, $10,000 to $25,000. The ROI on education can be enormous if you're strategic. An MBA from Harvard or Stanford can literally change your career trajectory, opening doors to 6-figure jobs and executive positions. A specialized certification or skill set can make you indispensable in your industry. But here's the thing: education is only valuable if you apply it. Spending $150,000 on an MBA makes sense if it leads to a $200,000 per year job. It doesn't make sense if you're just collecting degrees for the sake of it. The smarter approach might be to set aside a portion of your $1 million for education while investing the rest. Maybe $200,000 for education expenses and $800,000 invested. The investment returns can actually fund ongoing education for years to come. Part 6. Giving Back and Impact. Chapter 18. Charitable Giving and Philanthropy. Now let's talk about something that might actually make you happier than any investment or purchase: giving money away. Research consistently shows that spending money on others makes people happier than spending it on themselves. There's something deeply satisfying about making a real difference in the world. With $1 million, you could have a genuinely significant impact. Build a school in a developing country, $100,000 to $300,000. That's education for hundreds or thousands of kids over decades. Fund clean water projects providing wells and filtration systems for entire villages, $50,000 to $150,000. That's literally saving lives. Endow a scholarship fund at a university. $500,000 could generate $25,000 to $40,000 annually in scholarships forever, helping deserving students for generations. Support medical research for a disease that's affected your family. $100,000 to $500,000 could fund significant research that might lead to breakthroughs, help local homeless shelters, food banks, or community organizations. $50,000 to $200,000 could transform local organizations and help thousands of people in your own community. The beauty of having $1 million to give away is that you can be strategic. You're not just donating $50 here and there. You can fund entire projects and see tangible results. You could also set up a donor-advised fund, DAF, which gives you an immediate tax deduction while allowing you to distribute the money to charities over time. Donate $500,000 to your DAF this year, get a massive tax deduction, then grant it out to various charities over the next 5 to 10 years as you identify organizations doing great work. Or establish a private foundation, which gives you even more control over how the money is used. You could run programs, fund specific initiatives, and create a lasting legacy. The Gates Foundation, the Buffett Foundation, these all started with individuals deciding to give back in a structured way, and here's something most people don't realize. Giving money away can actually be financially beneficial. Charitable donations are tax deductible, which can significantly reduce your tax burden, especially in a year where you've had high income or capital gains. Plus, there's the intangible benefit of meaning and purpose. Making money is great, but making a difference? That's what people remember. That's what gives your life significance. Chapter 19: Impact Investing. But what if you want to do good and make money? Enter impact investing. Impact investing is putting your money into companies, funds, or projects that generate both financial returns and positive social or environmental impact. It's capitalism with a conscience. With $1 million, you could build a diversified impact investing portfolio, clean energy companies and funds, $300,000. Invest in solar, wind, battery technology, and other renewable energy solutions. You're supporting the transition away from fossil fuels while potentially making solid returns as the industry grows. Affordable housing developments, $200,000. Many projects need capital to build housing for low and moderate income families. Returns are typically 5 to 8% annually while providing a critical social service. Microfinance institutions, $150,000. These organizations provide small loans to entrepreneurs in developing countries, helping people start businesses and lift themselves out of poverty. Historical returns are around 5 to 7%. Sustainable agriculture and food companies, $150,000. Support companies working on solutions for food security, sustainable farming practices, and reducing the environmental impact of agriculture. Education technology and access, $100,000. Invest in companies making education more accessible and affordable. Healthcare innovations for underserved populations, $100,000. Support medical technologies and services aimed at improving healthcare in developing countries or underserved communities. The returns on impact investing vary widely, but can be competitive with traditional investments. Some impact funds have outperformed market averages, proving that you don't have to sacrifice returns to invest responsibly. The challenge is doing your due diligence. Some companies engage in impact washing, where they market themselves as socially responsible, but aren't really doing much. You need to verify that your investments are actually creating the impact they claim. Organizations like B Lab, which certifies B corporations, and various impact investing networks can help you identify legitimate opportunities. The beautiful thing about impact investing is that your money works twice. It generates returns for you while also making the world better. And if you structure it right, you can live off the returns, while the principal continues to create positive change indefinitely. Part 7: The Strategic Combinations. Chapter 20: The Diversified Millionaire Strategy. Here's the truth. The smartest use of $1 million probably isn't putting it all into one thing. It's diversification across multiple strategies. Let me lay out what a genuinely smart allocation might look like. $400,000. Core investment portfolio, $250,000 in low-cost index funds, S&P 500 international bonds, $100,000 in dividend-paying stocks and REITs, $50,000 in a mix of commodities, precious metals, and alternative assets. This is your foundation. It's boring, it's safe-ish, and it's designed to grow steadily over time while generating some income. $300,000, real estate, $100,000 down payment on a rental property, $100,000 into a REIT or real estate crowdfunding for diversification, $100,000 into your primary residence, either buying or renovating. Real estate provides inflation protection, tax benefits, and potential cash flow. $150,000, business/active income opportunity. Start a business, buy a franchise, or acquire an existing profitable business. This is your active income play, something you're involved in that can generate significant returns. $50,000, speculative/high risk, high reward. $25,000 in cryptocurrency, $25,000 in individual stocks, startup investments, or other speculative opportunities. This is your swing for the fences money. If it 10 times, amazing. If it goes to zero, your overall portfolio is fine. $50,000, education and skill development, courses, coaching, conferences, certifications. Invest in yourself and your earning potential. $30,000, charitable giving/impact, direct donations or impact investing. Feel good while doing good. $20,000, emergency fund, liquid cash for unexpected expenses. keeps you from having to sell investments at bad times. This diversified approach means you're building long-term wealth through index funds, you're generating cash flow through real estate and dividends, you're creating active income through business, you're taking some calculated risks with potential for massive returns, you're investing in yourself, you're making a positive impact, you're protected against emergencies. No single market downturn or failed investment destroys you because you're spread across multiple uncorrelated asset classes. Chapter 21: The Passive Income Lifestyle Design. Let's design a specific strategy focused entirely on generating passive income to support a lifestyle where you don't have to work. Goal: generate $60,000 to $80,000 per year in passive income, which is enough to live comfortably in many parts of the world. The allocation: $500,000. Dividend growth portfolio. Target yield: 4% equals $20,000 per year. This includes a mix of dividend aristocrats, REITs, and dividend-focused ETFs. The dividends should grow 5 to 7% annually, so your income increases over time. $300,000. Rental real estate down payments on 3 rental properties at $100,000 each. Target cash flow: $300 to $500 per month per property equals $10,800 to $18,000 per year. Plus, tenants are paying down your mortgages, building equity. $100,000. Peer-to-peer lending. Target return: 7% equals $7,000 per year. Diversified across hundreds of loans to minimize default risk. $100,000. Business/digital assets. This could be an online business generating passive revenue, courses, affiliate sites, apps, royalties from intellectual property. A small business you hire someone to run. Target: $12,000 to $24,000 per year. Total passive income: $49,800 to $69,000 per year. That's $4,150 to $5,750 per month without working a traditional job. But here's the kicker: you've still got money left over for reserves, and you own assets that are appreciating. Your $500,000 dividend portfolio might be worth $750,000 in 10 years. Your rental properties will have significant equity. Your business might be sellable for 2 to 3 times annual revenue. So you're living off passive income now while building long-term wealth for the future. Where could you live on $60,000 a year comfortably? Most of Southeast Asia: Thailand, Vietnam, Philippines. Parts of Central and South America: Mexico, Colombia, Ecuador. Southern and Eastern Europe: Portugal, Spain, Greece, Czech Republic. Many second-tier U.S. cities, if you're frugal. The geographic arbitrage is real. That $60,000 goes much further in Chiang Mai or Lisbon than it does in New York or San Francisco. Chapter 22: The Aggressive Wealth Building Strategy. Now let's flip it. What if you don't care about passive income right now? You're young, you're hungry, and you want to turn that million into 10 million as fast as possible? The allocation: $400,000. Real estate leverage. Use this as down payments on $2 million worth of real estate in high-growth markets. You're not looking for cash flow, you're looking for appreciation. Buy in emerging neighborhoods, gentrifying areas, cities with strong job growth. Target: 8 to 12% annual appreciation equals $160,000 to $240,000 per year in equity growth. $300,000. Start/buy a scalable business, something with massive upside potential, a tech startup, a franchise system you can scale, an e-commerce brand, a digital product business. Target: grow to $1 to $2 million valuation in 3 to 5 years. $200,000. Growth stocks and aggressive index funds, small cap funds, emerging market funds, sector-specific ETFs in high-growth industries, AI, clean energy, biotech. Target: 12 to 15% annual returns equals $24,000 to $30,000 per year, compounding rapidly. $100,000. Angel investing/venture capital. Invest in 10 to 20 early-stage startups at $5,000 to $10,000 each. Most will fail, but 1 or 2 might 10 times or 100 times, making the whole portfolio worthwhile. This strategy is high risk, high reward. You could absolutely lose significant money. But if things go right, you could turn your million into 5 or 10 million within 5 to 10 years. The key is being young enough to take the risk and recover if it doesn't work out. and having the skills and hustle to actively work on the business component. Part 8. The Psychology and Reality Check. Chapter 23. What most people actually do and why it's usually wrong. Let's get real for a second. If most people suddenly came into $1 million, here's what would probably happen. They'd buy a car they can't afford. To maintain, $100,000. They'd upgrade their house beyond their means, $400,000. They'd take some extravagant vacations, $50,000. They'd lend money to family and friends who'll never pay it back, $100,000. They'd make some dumb investments based on hot tips, $150,000. They'd spend the rest on lifestyle inflation, $200,000, and within 2 to 3 years, they'd be back where they started, except now they have a car they can't afford to maintain, a house with expensive upkeep, and relationships damaged by money lending gone wrong. This is why lottery winners statistically go broke. This is why athletes and entertainers who made millions end up filing for bankruptcy. Having money doesn't mean you know how to manage money. The psychology of sudden wealth is tricky. There's the temptation to finally buy all the stuff you've been wanting. There's pressure from family and friends who suddenly need your help. There's the belief that $1 million is more than it actually is in today's economy. The smartest thing you can do if you suddenly have $1 million? Nothing. At least not immediately. Park it in a high-yield savings account or money market fund for 6 to 12 months while you educate yourself about investing and wealth management. Consult with fee-only financial advisors, not commission-based salespeople. Think deeply about your values and goals. Create a comprehensive financial plan. Let the emotional high wear off so you can make rational decisions. The people who successfully build lasting wealth from windfalls are the ones who treat it seriously, plan carefully, and resist the urge to make impulsive decisions. Chapter 24. The Tax Implications. Nobody talks about. Here's something that'll bring you back to earth. Taxes. If you earn $1 million, you're not taking home $1 million. Depending on how you received it and where you live, you could be giving up 30 to 50% to taxes. Lottery winnings? That's ordinary income. Federal tax at the highest. Bracket is 37%, plus state taxes, which can add another 3 to 13% depending on where you live. Your million could be $500,000 to $600,000 after taxes. Inheritance? There's the federal estate tax, though the exemption is currently over $12 million, so most inheritances aren't taxed at the federal level, but some states have their own estate or inheritance taxes. Selling a business or investment property? Capital gains taxes apply. Long-term capital gains, held over a year, are taxed at 0%, 15%, or 20% depending on your income, plus the 3.8% net investment income tax for high earners, plus state taxes. You might pay 25 to 30% total. Cashing out stock options, that's ordinary income again, potentially pushing you into the highest tax brackets. The point is, you need to plan for taxes. If you're coming into $1 million through a sale or windfall, talk to a CPA before you finalize anything. There might be strategies to minimize taxes, spreading income across multiple years, offsetting gains with losses, using charitable donations strategically, investing in opportunity zones, utilizing retirement accounts. Paying an extra $10,000 for good tax advice could save you $100,000 plus in taxes. It's worth it. Chapter 25, The Lifestyle Inflation Trap. Here's the sneaky thing that happens when you come into money. Your lifestyle expands to match your wealth. You buy a nicer house, which has higher property taxes, utilities, and maintenance costs. You buy a luxury car, which has expensive insurance, premium gas, and costly repairs. You start eating at nicer restaurants, staying at better hotels, buying higher-end clothes. You upgrade everything: your phone, your laptop, your furniture, your wardrobe. Before you know it, you're spending $80,000 to $100,000 a year just to maintain your new lifestyle, when you used to live comfortably on $40,000. The problem? That $1 million doesn't generate enough passive income to support an $80,000 per year lifestyle indefinitely. At a 5% return, that's only $50,000 per year. You're burning through your principal. This is the trap that catches so many people. They think, I'm a millionaire now, I should live like one. But sustainable wealth isn't about spending what you have. It's about living on less than your investments generate. The people who stay wealthy are the ones who resist lifestyle inflation. They might upgrade some things that truly matter to them, but they stay relatively grounded. They drive nice but not extravagant cars. They live in comfortable but not ostentatious houses. They spend money on experiences and things they value, but they don't need to signal their wealth to the world. Warren Buffett still lives in the house he bought in 1958 for $31,500. He's worth over $100 billion. He could buy literally anything, but he's chosen not to inflate his lifestyle unnecessarily. You don't need to be that extreme, but the principle is sound. Your lifestyle should be based on your sustainable income, not your net worth. Chapter 26. The 7 Deadly Sins of Million-Dollar Management. Before we wrap this up, let's talk about the catastrophic mistakes people make when they come into serious money. These are the pitfalls that have destroyed fortunes and ruined lives. Learn from other people's expensive lessons so you don't have to make them yourself. Sin number 1, telling everyone. The moment people know you have $1 million, everything changes. Suddenly, you're everyone's favorite person. Your cousin who hasn't spoken to you in 5 years has a can't-miss business opportunity. Your old college roommate needs a small loan to get through a rough patch. Random acquaintances pitch you their startup ideas at parties. Here's the brutal truth: most people are terrible with money and they assume you'll be their ATM now that you're rich. The requests never stop. The expectations never end. And when you say no, which you should, relationships get damaged. The smartest, wealthy people keep their wealth quiet. They don't drive flashy cars, they don't brag about their investments, they don't announce their financial wins on social media. They live well, but they do it discreetly. There's an old saying, money talks, wealth whispers. Remember that. If you come into $1 million, tell as few people as possible. Your spouse or partner, obviously. Maybe your financial advisor and accountant. That's about it. Everyone else, they don't need to know. Sin number 2, mixing money and relationships. Lending money to family and friends seems generous and kind. In reality, it's a relationship destroyer. Here's what happens. Your brother-in-law needs $50,000 to save his struggling business. He swears he'll pay you back in 6 months. You want to help family, so you lend it to him. 6 months pass, no repayment. You ask about it, and he gets defensive. Business is tough right now. I'll get it to you soon. Another 6 months pass. Still nothing. Now family. Dinners are awkward. Your spouse is angry at their sibling. The whole family is taking sides. Eventually, you either write off the $50,000 and resent your brother-in-law forever, or you push for repayment and become the bad guy who cares more about money than family. There's no winning. The rule should be, if someone asks to borrow money, decide immediately if you're willing to give it to them as a gift with zero expectation of repayment. If yes, give it as a gift. If no, say no to the loan. This keeps relationships clean. Either you help someone because you genuinely want to, gift, or you don't help them at all, no loan. The middle ground of lending money to people you care about almost always ends badly. If someone truly has a good business opportunity and you want to invest, do it properly. Draw up legal agreements, set clear terms, treat it like a real investment. Don't just hand over cash with a handshake and a hope. Sin number 3, falling for get-rich-quicker schemes. When people know or suspect you have money, the scammers come out of the woodwork. Cryptocurrency advisors promising 50% monthly returns, real estate gurus selling overpriced seminars and mentorship programs, multi-level marketing schemes disguised as business opportunities, stock experts with foolproof systems, forex traders with guaranteed winning strategies. Here's the reality: if something sounds too good to be true, it absolutely is. Legitimate investments don't promise crazy returns with no risk. Real financial advisors charge reasonable fees and set realistic expectations. Actual business opportunities require work, skill, and time to pay off. The people making these outrageous promises are either delusional or they're scammers trying to separate you from your money. Sometimes both. Before investing in anything, research the person or company thoroughly, check their credentials and track record, look for independent reviews and complaints, understand exactly where your money is going and how it's being used, get everything in writing, have a lawyer review any contracts, trust your gut. If something feels off, walk away. Remember, you worked hard or got lucky to get this $1 million. Don't give it away to smooth-talking con artists. Sin number 4, trying to time the market. Here's a fantasy that destroys wealth. I'll invest my $1 million when the market bottoms out, then sell at the peak and make millions more. Sounds great. Doesn't work. Professional investors with teams of analysts, sophisticated algorithms, and decades of experience can't consistently time the market. What makes you think you can? Study after study shows that time in the market beats timing the market. The person who invested $10,000 in an S&P 500 index fund in 1990 and never touched it has way more money than the person who tried to jump in and out based on market predictions. Why? Because you'll inevitably miss the best days. The market's biggest gains often happen on random days that nobody predicts. If you're sitting in cash waiting for the right time to invest, you miss those gains. Plus, the tax implications of constantly buying and selling are brutal. Every sale triggers capital gains taxes. Frequent trading generates short-term capital gains, which are taxed at higher rates than long-term holdings. The smart play: develop an investment strategy based on your goals and timeline, invest according to that strategy, and stick with it through market ups and downs. Rebalance periodically, yes. Make adjustments as your situation changes, absolutely, but don't try to outsmart the market with perfect timing. You'll lose. Sin number 5, neglecting asset protection. You've got $1 million. Congratulations, you're now a target for lawsuits. Get in a car accident, someone might sue you for everything you've got. Run a business, customers, employees, or partners might sue you. Own rental properties, tenants might sue you. Exist in modern America, someone might sue you for basically anything. This is why asset protection is crucial when you have significant wealth. Strategies include umbrella insurance policies that provide $1 to $5 million in liability coverage beyond your regular insurance, LLCs for business activities and rental properties, properly titling assets to maximize protection, trusts that shield assets from creditors, adequate insurance on everything, home, cars, business, health, following all laws and regulations to avoid legal problems. The cost of proper asset protection is maybe $5,000 to $15,000 to set up, plus annual maintenance costs. That's a tiny price to pay to protect $1 million net worth from a single lawsuit that could wipe you out. Don't skip this step. One accident, one angry ex-employee, one slip and fall on your property, and your entire financial life could be destroyed if you're not properly protected. Sin number 6, ignoring estate planning. Nobody likes thinking about death, but if you have $1 million, you need an estate plan. Without proper planning, here's what happens when you die. Your assets get stuck in probate for months or years. Court fees and attorney costs eat up a significant percentage. Family members fight over who gets what. The government takes a bigger cut than necessary in taxes. Your actual wishes may not be honored with proper planning. Your assets transfer quickly and smoothly to your chosen beneficiaries. You minimize estate taxes and fees, you avoid family conflict by making your wishes crystal clear, you can set up trusts for minor children or beneficiaries who might not be ready to handle large sums, you maintain privacy, probate is public, trusts are private. An estate plan typically includes a will stating your wishes, a revocable living trust to avoid probate, powers of attorney for financial and healthcare decisions, healthcare directives, living will, beneficiary designations on all accounts. A. Plan for business succession if you own a business. Cost $2,000 to $10,000 depending on complexity. Worth every penny for the peace of mind and protection it provides your family. Plus, estate planning isn't just about death. The powers of attorney and healthcare directives protect you if you become incapacitated. If you're in an accident and can't make decisions, someone you trust needs legal authority to manage your affairs. Without these documents, your family might have to go to court to get that authority. Sin number 7, letting money define you. The final and perhaps most important mistake, letting your $1 million change who you are. Money amplifies personality. If you were generous before, you might become philanthropic. If you were insecure before, you might become flashy and show off. If you were anxious before, you might become paranoid about losing it. The healthiest approach is to view money as a tool, not as an identity. You're not a millionaire, so you're the same person you were before, just with more financial resources. Your values shouldn't change. Your relationships shouldn't change. Your character shouldn't change. The people who handle wealth best are the ones who maintain perspective. They remember what it was like to struggle. They stay connected to people from all economic backgrounds. They use money to support their values, not replace them. They find purpose beyond accumulating wealth. They raise their children with work ethic and appreciation, not entitlement. They give back because they genuinely want to help, not for recognition. Money can make life easier, more comfortable, more secure. It can provide opportunities and experiences, but it can't make you a better person. That's on you. The most miserable rich people are the ones who thought money would solve all their problems or fill some void in their lives. It doesn't. All the same human challenges exist. They just happen in nicer houses. Stay humble, stay grateful, stay grounded, and remember that at the end of your life, nobody will care how much money you had. They'll care about how you treated people, what you contributed, and the legacy you left behind. Chapter 27. What $1 million means around the world. Here's something that'll blow your mind. $1 million has radically different purchasing power depending on where you are in the world. In San Francisco, you're barely middle class. In rural Thailand, you're essentially royalty. Let's break down what your $1 million actually buys you in different parts of the world, because this geographic arbitrage is one of the most underutilized strategies for making your money go further. United States, the reality check. Starting with the US, because that's where most people watching this are probably from. $1 million in America is complicated. In Manhattan, your million might buy you a 500 square foot studio apartment. Seriously, the median price per square foot in Manhattan is over $1,500. You're looking at a tiny apartment, probably with a view of a brick wall, and you'll still have a mortgage if you want anything remotely livable. Move to San Francisco, and it's not much better. The median home price hovers around $1.3 million. Your $1 million gets you into a bidding war for a fixer-upper in a decent neighborhood. But shift to Dallas, Texas, and suddenly that million buys you a gorgeous 4,000 square foot house with a pool in a great neighborhood with excellent schools. You'd have $400,000 to $500,000 left over to invest. Go even further to somewhere like Detroit, and you could buy 10 houses for $1 million. 10. You could become a serious real estate investor with a substantial rental portfolio. The median household income in the US is around $75,000. If you invested your million in a conservative portfolio yielding 5%, that's $50,000 annually, putting you below the median income. You're not rich, you're just okay. But invest it wisely, generate 8 to 10% returns, and you're looking at $80,000 to $100,000 annually, which puts you solidly middle to upper middle class in most of America, Southeast Asia, the expat paradise. Now, let's talk about where your million really shines. Southeast Asia. In Thailand, the cost of living in a place like Chiang Mai is absurdly low by Western standards. You can rent a beautiful modern apartment for $400 to $600 per month, eat delicious street food for $2 to $3 per meal, or have a nice sit-down dinner for $10 to $15. Get a massage for $8. Have your laundry done for $1.50 per kilo. A comfortable lifestyle in Chiang Mai costs maybe $1,500 to $2,000 per month, or $18,000 to $24,000 per year. Your $1 million, invested conservatively at 5%, generates $50,000 annually. You could live extremely well on half of that and reinvest the rest, growing your wealth while enjoying an amazing lifestyle. Vietnam is even cheaper. In Da Nang or Hanoi, you can live like a king on $1,200 to $1,800 per month. That's everything. Rent, food, transportation, entertainment, occasional travel. The Philippines? Bali? Similar story. Your $1 million nest egg suddenly makes you wealthy in real, tangible, everyday terms. And we're not talking about slumming it. We're talking beautiful accommodations, great food, access to healthcare, which is excellent and affordable in many Asian countries, vibrant expat communities, and incredible quality of life. The catch? You're far from family and friends in the US. There are cultural adjustments, language barriers, visa requirements. But for digital nomads, remote workers, retirees, or anyone who can work location independently, this is an incredible option. Latin America, the closer alternative. Don't want to move halfway around the world? Latin America offers similar cost of living benefits with the advantage of being in closer time zones and often just a few hours flight from the US. Medellin, Colombia has become a digital nomad hotspot. The weather is perfect year-round. They call it the City of Eternal Spring. The cost of living is low, and the quality of life is high. You can rent a nice apartment in a good neighborhood for $400 to $700 per month, eat well for $200 to $300 monthly, live comfortably on $1,500 to $2,000 total. Mexico City, Playa del Carmen, or Puerto Vallarta in Mexico offer similar benefits with even easier access to the US. Many Americans retire in Mexico precisely because their savings go so much further. Ecuador has become a retirement haven. The country even uses the US dollar as its official currency, eliminating exchange rate worries. In cities like Cuenca or Quito, you can live extremely well on $1,500 to $2,500 per month. Portugal has become insanely popular with American and British expats. Lisbon and Porto offer European culture, excellent food and wine, beautiful architecture, mild weather, and a cost of living significantly lower than most of Western Europe. Your $1 million buys you a very comfortable life in Portugal, Eastern Europe, the hidden gem Prague, Czech Republic, Budapest, Hungary, Krakow, Poland, Bucharest, Romania. These cities offer incredible value. Beautiful historic cities with rich culture, great public transportation, excellent beer and food, and costs that make Western Europe look insane by comparison. In Prague, you can rent a gorgeous apartment in the city center for $800 to $1,200 per month. Eat at nice restaurants for $15 to $25 per person. Enjoy world-class beer for $2 to $3 per pint. Travel easily throughout Europe thanks to budget airlines and trains. Total monthly budget for a very comfortable life: $2,000 to $3,000. That's $24,000 to $36,000 annually. Your $1 million portfolio generating 5% covers this easily with money left over to reinvest. The quality of life in these cities is genuinely excellent. Good healthcare, low crime in most areas, vibrant cultural scenes, and welcoming attitudes toward foreigners. The geographic arbitrage strategy. Here's how smart people use geographic arbitrage. They earn money in high-income countries, the US, Western Europe, or from location-independent businesses, then spend that money in lower-cost countries. Your $1 million invested in US index funds generates returns in US dollars, but you spend those returns in Thai baht, Mexican pesos, or Vietnamese dong, where they go 2 to 3 times further. This is how people retire at 35 or 40. They're not actually wealthy by US standards, but by moving to lower-cost countries, their modest investment income supports a comfortable lifestyle. The math works like this. $1 million invested at 6% equals $60,000 annual income. Living in the US on $60,000 equals modest lifestyle, probably still working. Living in Thailand on $60,000 equals upper-class lifestyle, completely retired. Living in Portugal on $60,000 equals comfortable middle-class life in a beautiful European country. You're essentially hacking the system by taking advantage of purchasing power differences across countries. Chapter 28. The Hidden Costs. Nobody warns you about. All right, we need to talk about the costs that creep up on you when you have $1 million. The stuff that financial advisors don't always emphasize because they want you to feel good about your money. Wealth management fees. If you hire a traditional financial advisor, they typically charge 1% of assets under management annually. On $1 million, that's $10,000 per year. Only 1%, they'll say, barely anything. But let's run the real numbers. Over 30 years, assuming 7% average annual returns, without fees, DIY index fund investing, your $1 million grows to $7.6 million. With 1% annual fees, your $1 million grows to $5.7 million. That small 1% fee cost you $1.9 million over 30 years, nearly $2 million that went to your advisor instead of staying in your pocket. Now, if your advisor is genuinely adding value, helping you avoid stupid mistakes, optimizing your tax strategy, keeping you disciplined during market crashes, that fee might be worth it. But many advisors are basically just putting your money in index funds and collecting a paycheck for doing what you could do yourself in 20 minutes. This is why fee-only advisors, who charge flat fees or hourly rates instead of percentages of assets, are often better. Pay $2,000 to $5,000 for a comprehensive financial plan, then execute it yourself. You save hundreds of thousands over your lifetime. The inflation monster. Everyone knows inflation exists, but people don't internalize what it means for their $1 million. At the historical inflation rate of 3% annually, here's what happens to your purchasing power. Year 0, $1 million in purchasing power. Year 10, $744,000 in purchasing power. Year 20, $554,000 in purchasing power. Year 30, $412,000 in purchasing power. Your $1 million loses more than half its purchasing power over 20 years if you're just holding cash or earning returns that don't beat inflation. This is why safe strategies like keeping everything in savings accounts or CDS earning 2 to 3% are actually risky. You're losing purchasing power every year. You need returns that beat inflation by a meaningful margin just to maintain your standard of living. Lifestyle creep, the silent killer. We touched on this earlier, but it deserves more attention because it's insidious. You start with $1 million. You're smart, you invest it, you're earning $50,000 to $70,000 annually in passive income. Life is good, but then small upgrades start happening. You move from a $1,200 per month apartment to a $1,800 per month apartment. Just $600 more monthly, $7,200 annually. No big deal, right? You upgrade your car. Your old reliable Honda becomes a new BMW. The payment is $600 per month instead of $0 because you paid cash for the Honda. That's another $7,200 annually. You start eating out more. You used to spend $300 per month on groceries and ate at home. Now you're spending $400 on groceries plus $300 eating out because you have the money now. That's $400 more monthly, $4,800 annually. Vacations get nicer. Used to do road trips and budget hotels. Now you're flying places and staying at nice resorts. Extra $5,000 annually. Clothes get nicer. Electronics get upgraded more frequently. You get a cleaning service. You pay for premium subscriptions to everything. Before you know it, your annual expenses have gone from $35,000 to $60,000. Your investment income covers it, so you don't notice the problem immediately. But now you're not building wealth. You're not reinvesting returns. Your million isn't growing. Adjusted for inflation, you're actually getting poorer every year even though you feel richer. 10 years later, you're in the exact same financial position or worse, just living in a nicer apartment and driving a nicer car. You haven't built generational wealth. You've just funded a slightly upgraded lifestyle. Family expectations and obligations. This one is emotional and financial. When family knows you have money, expectations change. Your parents might expect you to help with their retirement. Siblings might expect you to help with their kids' college. Extended family might expect you to be the generous one at holidays and celebrations. These expectations are rarely explicit. Nobody says, "You're rich now, so you need to pay for everything." It's more subtle. Comments about how nice it must be to have money, hints about their financial struggles, guilt trips about family obligations. Before you know it, you're helping with your parents' medical bills, $5,000 to $15,000 annually, contributing to nieces and nephews' college funds, $3,000 to $10,000 annually, being the family member who always picks up the check, $2,000 to $5,000 annually, helping siblings with emergencies, $5,000 to $20,000 annually. Suddenly, you're spending an extra $15,000 to $50,000 per year on family obligations. Again, your returns cover it so it doesn't feel like a problem. But it's bleeding away the wealth you could be building. The solution isn't to be heartless with family, it's to set clear boundaries. Decide in advance what you're willing to help with and what you're not. Communicate those boundaries clearly. Stick to them even when it's uncomfortable. Help in ways that empower rather than create dependency. Give your parents $20,000 once to set up their retirement plan properly instead of giving them $2,000 every year to cover shortfalls. Pay for your nephew's college directly instead of lending your sibling money that disappears into their general budget. Help strategically, not emotionally. The friend tax. Similar to family, but often worse because the expectations are less justified. When friends know you have money, weird things happen to friendships. Some friends get weird about money, either being overly cautious, "Oh, this restaurant is probably too cheap for you now," or overly presumptuous, "You can afford it, just get this round." Group trips become complicated. You want to go nice places, but you don't want friends to feel like you're flaunting wealth or expecting them to keep up with your spending. Business opportunities with friends sound great until they go south and the friendship is destroyed. The friend tax is all the social and emotional costs of having money while maintaining friendships with people at different income levels. It's not always financial, but it often becomes financial when you're constantly adjusting your lifestyle downward for social situations or picking up tabs to avoid awkwardness. The opportunity cost of bad decisions. Every dollar you spend or invest poorly has an opportunity cost. What that dollar could have become if you'd used it wisely. Spend $50,000 on a car that depreciates to $25,000. The opportunity cost isn't just the $25,000 you lost, it's what that $50,000 could have. Grown to if invested. At 8% annual returns over 20 years, that $50,000 becomes $233,000. So your car actually cost you $233,000 in future wealth, not $50,000. Make several of these suboptimal decisions, and the opportunity costs compound into millions of dollars of lost wealth over a lifetime. This isn't to say you should never buy anything or enjoy your money, it's to make you aware that every financial decision has ripple effects through your entire financial future. Extended Part 10, The Advanced Strategies. Chapter 29, The Infinite Banking Concept. Here's a strategy that sounds weird but actually works for wealthy people, using whole life insurance as a personal banking system. Traditional financial advice says term life insurance good, whole life insurance bad, and for most people that's true. Whole life is expensive, has high fees, and the returns are mediocre, but used strategically with $1 million, it can be powerful. Here's how it works. You buy a dividend-paying whole life insurance policy from a mutual insurance company. Let's say you put $100,000 of your million into a well-designed policy. The policy builds cash value that grows tax-deferred. After a few years, you have significant cash value you can borrow against at low interest rates, typically 5 to 6%. Here's where it gets interesting. When you borrow against your policy, your cash value continues to grow as if you hadn't borrowed against it. You're essentially using the insurance company's money while your money keeps compounding. You can use these loans for anything: real estate investments, business opportunities, even major purchases. You're becoming your own bank, borrowing from yourself instead of from traditional lenders. The loans don't have to be repaid on any schedule, though interest accrues. When you die, the death benefit pays off any outstanding loans, and the remainder goes to your beneficiaries tax-free. Wealthy families use this strategy for generations, creating a pool of capital that can be borrowed, repaid, and borrowed again indefinitely. Is it better than just investing in index funds? Debatable. The returns are lower, the fees are higher, and it's complex. But it offers unique benefits: tax-advantaged growth, access to capital without selling investments, asset protection in many states, and forced savings discipline. With $100,000 to $300,000 of your million allocated to properly designed whole life policies, you create a financial tool that can serve you and your family for generations. Chapter 30. The 1031 Exchange Real Estate Strategy. If you're going heavy into real estate with your million, you need to understand the 1031 Exchange. It's one of the most powerful tax strategies available to real estate investors. Here's the concept. Normally, when you sell a property for a profit, you owe capital gains taxes. Sell a property you bought for $200,000 for $400,000, and you owe taxes on that $200,000 gain. At a 20% capital gains rate plus state taxes, that could be $50,000 to $60,000 going to taxes. But Section 1031 of the tax code allows you to defer those taxes indefinitely if you reinvest the proceeds into another like-kind property within strict timeframes. Here's how smart investors use this with $1 million portfolio. Year 1, buy a rental property for $300,000 with $60,000 down and financing the rest. Year 5, the property is now worth $450,000. Instead of selling and paying taxes, you do a 1031 exchange into a $600,000 property, using the $450,000 from the sale plus new financing. Year 10. That property is now worth $850,000. You exchange into a $1.2 million property. Year 15. That property is worth $1.7 million. You exchange into a $2.5 million property. You've gone from a $300,000 property to a $2.5 million property without ever paying capital gains taxes. All those gains kept compounding. because you didn't have to give 20 to 30% to the government at each step. Eventually, when you die, your heirs inherit the property with a stepped-up basis, meaning they can sell it without owing taxes on all that appreciation. The capital gains taxes are essentially forgiven. This is how real estate dynasties are built. The wealthy understand that every dollar not paid in taxes is a dollar that keeps working for you. With your $1 million, you could buy 3 to 4 properties with leverage, then strategically exchange up over the years, building a portfolio worth tens of millions while deferring taxes indefinitely. Chapter 31. The Roth Conversion Ladder. Here's a tax strategy for the sophisticated investor. The Roth Conversion Ladder. If you have money in traditional IRAs or 401s, Ks, you'll owe ordinary income tax when you withdraw it in retirement. But money in Roth IRAs grows tax-free and comes out tax-free. The Roth Conversion Ladder is a strategy to convert traditional retirement funds to Roth funds while minimizing taxes. Here's how it works. Let's say part of your million is in a traditional IRA. Each year, you convert a portion of it to a Roth IRA. You pay taxes on the conversion amount at your current tax rate. The key is to do this strategically during years when your income is low. Maybe you retire early or take a sabbatical. Your income drops, putting you in a lower tax bracket. This is when you convert. Convert $50,000 from traditional to Roth during a year when you're in the 12% tax bracket instead of your usual 24% bracket. You just save $6,000 in taxes on that conversion. Do this systematically over 5 to 10 years, and you can move your entire traditional IRA to Roth, paying minimal taxes and setting yourself up for completely tax-free income in retirement. The latter part refers to timing. Money converted to Roth must sit for 5 years before you can withdraw it penalty-free if you're under 59.5. So you convert year 1, that money is accessible year 6. Convert year 2, accessible year 7. By year 6, you have a constant stream of accessible Roth money. This is how sophisticated early retirees fund their lifestyles. Live on a small amount, do Roth conversions to fill up low tax brackets, and create a pipeline of tax-free money for the future. Chapter 32. The Qualified Small Business Stock, QSBS, Strategy. Here's a tax break that could save you millions, but almost nobody knows about. Qualified Small Business Stock under Section 1202. If you invest in certain small businesses, C corporations with less than $50 million in assets, hold the stock for at least 5 years, and the company meets specific requirements, you can exclude up to $10 million in capital gains from federal taxes when you sell. Let me repeat that. Up to $10 million in tax-free gains. With your $1 million, you could invest in 10 to 20 qualifying startups at $50,000 to $100,000 each. Most will probably fail. That's the nature of startups. But if just 1 or 2 become successful and you make millions in gains, those gains could be completely tax-free under QSBS. Compare that to normal capital gains. Make $5 million on a startup investment, pay 20% federal plus 3.8% net investment income tax plus state taxes. You're giving up $1.3 to $1.5 million to taxes. Under QSBS, if structured correctly, you keep the entire $5 million. The requirements are specific. Must be a C corporation. Must have less than $50 million in assets when you invest. Must be an active business, not real estate, finance, or certain other passive businesses you must hold for 5+ years, various other technical requirements. This is advanced stuff that requires working with knowledgeable tax advisors and attorneys. But for angel investors and early-stage startup investors, it's one of the most powerful tax strategies available. With $200,000 to $300,000 of your million allocated to QSBS-eligible investments, you're potentially setting yourself up for millions in tax-free gains if you pick even one winner. Chapter 33. The Backdoor Roth and Mega. Backdoor Roth high earners often can't contribute directly to Roth IRAs because their income exceeds the limits, but there are legal workarounds. The Backdoor Roth. 1. Contribute $7,000 to a traditional IRA. Anyone can do this regardless of income. 2. Immediately convert it to a Roth IRA. 3. Pay taxes on the conversion, minimal if done immediately. 4. Now you have $7,000 in a Roth IRA that will grow tax-free forever. This isn't a huge amount, but it's something. Do it every year for 30 years, and you've got $210,000 contributed that compounds tax-free. The mega backdoor. Roth. This is much more powerful but requires a cooperative employer 401k plan. 1. Max out your regular 401k contribution, $23,000 in 2024. 2. Make additional after-tax contributions to your 401k up to the total limit, $69,000 in 2024. 3. Immediately convert those after-tax contributions to Roth, either Roth 401k or Roth IRA 4. You've now got up to $46,000 additional. Dollars in Roth accounts. Do this for 10 years and you've got $460,000 in Roth accounts that will never be taxed again. Let that compound for 20 to 30 years and you're looking at millions in tax-free retirement money. Not everyone has access to this. Your employer's 401k must allow after-tax contributions and in-service conversions. But if you do, it's an incredibly powerful strategy. With your $1 million net worth, you should be maxing out every tax-advantaged account available. 401k, IRA, HSA, 529 for kids, and using strategies like backdoor Roth to get even more money into tax-protected accounts. Extended Part 11, the psychological and philosophical aspects. Chapter 34, the hedonic treadmill and why more money doesn't equal more happiness. Let's talk about something uncomfortable. Research shows that after a certain point, around $75,000 to $100,000 annual income for most people, more money doesn't significantly increase happiness. This is called the hedonic treadmill or hedonic adaptation. Basically, humans adapt to their circumstances. That new car is exciting for a few weeks, then it's just your car. That luxury apartment is amazing at first, then it's just where you live. Lottery winners, after an initial spike in happiness, typically return to their baseline happiness level within a year or two. They've adapted to being rich, and it's not as exciting anymore. So what does this mean for your $1 million? It means that spending it all on lifestyle upgrades, the bigger house, the luxury car, the designer clothes, probably won't make you sustainably happier. You'll get a temporary boost, then adapt, and you'll be back where you started emotionally, just with a more expensive lifestyle to maintain. The research suggests that money contributes most to happiness when spent on experiences over things. That trip to Japan creates lasting memories and personal growth. The expensive watch just sits on your wrist. Time. Freedom. Money that buys you freedom from work you hate, time with family, ability to pursue hobbies. This creates lasting happiness. Helping others. Charitable giving and spending money on others correlates with happiness more than spending on yourself. Security and stress reduction. Having an emergency fund and financial security reduces anxiety, which increases baseline happiness. Personal growth. Money spent on education, skills, health, and self-improvement tends to have lasting benefits. So the happiest use of your million might not be buying the most expensive stuff. It might be investing enough to create financial security and reduce money stress, using some for meaningful experiences and travel. Buying time freedom, reducing work hours, hiring help for tasks you hate, giving meaningfully to causes you care about, investing in your health, education, and personal growth, spending on relationships, quality time with family, bringing friends on, trips. A modest lifestyle with financial security, time freedom, and meaningful experiences will likely make you happier than a lavish lifestyle with no time, high stress, and constantly chasing the next purchase. Chapter 35. The identity shift of wealth. Having $1 million changes how you see yourself and how others see you. This identity shift can be subtle or dramatic, and it affects your psychology in ways you might not expect. Imposter syndrome. Many people who come into significant money feel like frauds. I don't deserve this. I'm not really wealthy. Real rich people have way more than me. This imposter syndrome can lead to self-sabotage. You might make bad financial decisions because you don't feel worthy of the money. You might give it away too freely. You might avoid learning about wealth management because you don't see yourself as a wealthy person. The solution is to accept your new financial reality without letting it define your entire identity. You have $1 million. That's a fact. It doesn't make you better or worse than anyone else. It's just a resource you now have. The responsibility weight. Money comes with responsibility. You're now responsible for managing a significant asset. The decisions you make affect not just you, but potentially your family for generations. Some people find this energizing, others find it paralyzing. What if I mess this up? What if I lose it all? What if I make the wrong choice? This responsibility anxiety can lead to decision paralysis, not investing at all, keeping everything in cash, missing opportunities because you're too scared to take any action. The solution is education and delegation. Learn enough to make informed decisions, but don't feel like you have to become a financial expert. Hire good advisors. Make decisions with appropriate caution, but don't let fear prevent all action. Relationship changes. Your relationship with money changes, and your relationships with people change too. You might feel guilty about having money when friends or family struggle. You might feel pressure to help everyone. You might feel isolated because people treat you differently. Some relationships will change for the worse. People who can't handle your success, who become resentful or entitled, who only see you as a source of money, these relationships might need to end, but other relationships will deepen. The people who are genuinely happy for your success, who respect your boundaries, who relate to you as a person rather than a wallet, these relationships become more valuable and meaningful. The purpose. Question: when money is no longer your primary concern, even if you're not mega rich, $1 million provides options, you face the existential question, what's my purpose? If you've been grinding for years to make money, suddenly having financial security can be disorienting. What do I do now? Who am I if not someone trying to make money? This is why some lottery winners end up miserable. They achieve financial success but have no sense of purpose beyond making money. The solution is to develop purpose beyond wealth. What do you care about? What problems do you want to solve? What legacy do you want to leave? How do you want to spend your limited time on Earth? Money becomes a tool to serve your purpose rather than being the purpose itself. Chapter 36: The Long Game versus the Short Game. $1 million forces you to choose between two fundamentally different approaches to wealth. The short game: maximize current lifestyle. This is the enjoy it now approach. You invest for safe, steady income. You spend generously on experiences and lifestyle. You live well in the present, accepting that you might not build massive long-term wealth. With this approach, you might invest for 5 to 6% returns in conservative dividend stocks and bonds, generate $50,000 to $60,000 annually, supplement with some part-time work you enjoy, travel extensively, live in beautiful places, enjoy life now while you're young and healthy. The upside: you actually enjoy your money. You don't defer happiness to some distant future that might never come. You create memories and experiences while you can. The downside: you might not be building generational wealth. Your million might be worth the same or less, adjusted for inflation, in 20 years. You're not setting up your kids or grandkids for financial security. The long game: build generational wealth. This is the sacrifice now to build for the future approach. You live modestly, reinvest aggressively, and focus on growing your million into 10 or 50 million over decades. With this approach, you might invest for 10 to 15% returns in growth stocks, real estate, businesses, reinvest all returns for 10 to 20 years, live on separate income from work or business, keep lifestyle modest to maximize wealth accumulation, build a foundation for generational wealth. The upside: you could turn your million into $10 to $50 million over 20 to 30 years. You set up your family for generations. You build something that lasts beyond your lifetime. The downside: you might sacrifice present enjoyment for future wealth. There's always the risk of dying before you get to enjoy it. You might create financial security for your kids, but miss out on experiences with them. The middle path. Most people benefit from a hybrid approach. Live comfortably, but not extravagantly now. Invest aggressively enough to build long-term wealth. Spend on high-value experiences and relationships. Reinvest most returns, but use some for current life quality. Maybe that looks like $700,000 invested for aggressive long-term growth, $300,000 invested for current income, generate $20,000 to $30,000 annually to enhance current lifestyle. Let the $700,000 compound into millions over time. Supplement with work you enjoy that adds purpose and income. This way, You're building for the future while actually living in the present. The key is to be intentional about your choice. Don't accidentally end up in the short game by spending all your money without realizing it. Don't accidentally end up in the long game, being 80 years old with $20 million and regrets about all the experiences you never had. Choose your balance deliberately based on your values, your stage of life, your health, and your priorities. There's no wrong answer, only wrong answers for you specifically. Extended Part 12, The Unconventional Paths, Chapter 37, The Content Creator Economy. Here's a use of $1 million that didn't exist 15 years ago but is incredibly powerful today, building a media empire. With $1 million, you could establish yourself as a serious content creator across multiple platforms and potentially build something worth tens of millions. Here's the strategy. Initial investment breakdown, $300,000, professional. Production setup, state-of-the-art filming equipment, $50,000, professional editing suite and computers, $30,000, soundproofing and studio construction, $40,000, lighting, cameras, microphones, accessories, $30,000, software licenses and tools, $10,000, professional website and branding, $20,000, reserve for upgrades and repairs, $120,000, $200,000, team building, full-time video editor, 1 year, $60,000, thumbnail designer and graphics specialist, 1 year, $50,000, social media manager, 1 year, $45,000, business manager / assistant, 1 year, $45,000, $150,000, content production budget, travel for content creation, $50,000, props, sets and materials, $30,000, guest appearances and collaborations, $20,000, research and development, $20,000, miscellaneous production costs, $30,000, $200,000, marketing and growth, paid advertising across platforms, $80,000, SEO and algorithm optimization consultants, $30,000, collaboration fees with established creators, $40,000, PR and media outreach, $20,000, conference attendance and networking, $30,000, $150,000, business operations and reserve, legal, LLC formation, contracts, trademark, $20,000, accounting and tax planning, $15,000, insurance, liability, equipment, health, $15,000, emergency fund for unexpected costs, $100,000. With this setup, you're not just a hobbyist making videos in your bedroom. You're running a professional media company with the infrastructure to compete with established creators. The revenue potential. A successful YouTube channel with 500,000 subscribers can generate ad revenue, $50,000 to $150,000 annually, sponsorships, $100,000 to $500,000 annually, merchandise, $50,000 to $200,000 annually, digital products, courses, ebooks, $50,000 to $300,000 annually, speaking engagements, $25,000 to $100,000 annually, total potential, $275,000 to $1,250,000 annually, and that's just YouTube. Add Instagram, TikTok, podcasting, and other platforms, and the numbers multiply. Mr. Beast started with basically nothing and built a media empire worth hundreds of millions. Emma Chamberlain went from bedroom vlogs to a multi-million-dollar brand. The Paul brothers turned controversial content into $20 million plus annual incomes. Your $1 million investment gives you the resources to produce high-quality content from day one, skip the years of grinding with poor equipment, and accelerate your path to success. The key differentiator? Most creators are limited by budget. They can't afford the best equipment, can't hire a team, can't travel for content, can't invest in growth. You can do all of that immediately, giving you a massive competitive advantage. The exit strategy. Successful content businesses sell for 2 to 4 times annual revenue. If you build a channel generating $500,000 annually, you could sell it for $1 to $2 million. Build it to $2 million annually, sell for $4 to $8 million, or don't sell at all. Keep it as a cash-flowing asset that generates income for decades. Transition to more of an executive role, hire talent to be on camera, and collect checks while others do the work. This is how smart creators think. They're not just making videos, they're building valuable businesses. Chapter 38: The Education and Certification Arbitrage. Here's an underutilized strategy. Use your $1 million to acquire high-value skills and certifications that dramatically increase your earning potential. The medical route. Becoming a physician takes 4 years of medical school plus 3 to 7 years of residency. Most people graduate with $200,000 to $400,000 in debt. With $1 million, you could pay for medical school completely, $250,000 to $350,000, cover living expenses for 4 years, $120,000, pay for residency years when you earn, but not much. Covered. Have money left to invest, $400,000 plus graduate debt-free as a physician, earning $200,000 to $500,000 plus annually, depending on specialty. Your lifetime earnings increase by millions compared to peers who spent decades paying off loans. The $400,000 you invested continues growing. At 8% annually over 30 years while you're working as a doctor, that becomes $4 million. Combined with your high physician income, you're building serious wealth. The legal route. Law school is expensive. $150,000 to $250,000 for 3 years. With your $1 million, you pay for law school, $200,000, cover living expenses, $90,000, have remaining capital, $710,000, graduate and land a big law job, earning $200,000 plus starting salary. Within 5 years, you're making $300,000 to $400,000. Your invested $710,000 grows while you earn a high income. The tech certification route. This is faster and cheaper, but still lucrative. Invest $50,000 to $100,000 in coding boot camps and courses, cloud certifications, AWS, Azure, Google Cloud, data science and machine learning programs, cybersecurity certifications, product management training. Land a tech job earning $120,000 to $180,000 within a year. You still have $900,000 plus to invest while earning a high income. The specialized trade route. Even faster. Become a specialized tradesperson. Underwater welding certification. $15,000 to $20,000. Earning potential. $100,000 to $300,000 annually. Remaining capital to invest, $980,000. Aircraft mechanic certification, $30,000 to $40,000. Earning potential, $70,000 to $120,000 annually. Remaining capital, $960,000. Elevator technician apprenticeship and training, $10,000 to $20,000. Earning potential, $80,000 to $120,000 plus annually. Remaining capital, $980,000. The strategy. The brilliance of this approach is that you're using a small portion of your million to dramatically increase your earning potential, while the majority continues growing through investments. Someone who spends $300,000 on medical school, but invests the remaining $700,000, has both high income from their medical career and investment income from their portfolio. Within 15 to 20 years, they could easily be worth $5 to $10 million between career earnings, savings, and investment growth. Compare this to someone who went into debt for medical school. They're spending their first 10 to 15 years paying off loans instead of investing. By the time they're debt-free, you're already a multimillionaire. Chapter 39: The Franchise Empire Builder. We touched on franchises earlier, but let's go deeper into building a true franchise empire with your million. The multi-unit strategy. Most franchise agreements allow and encourage multi-unit ownership. Here's how you build an empire. Phase 1. Proof of concept. Months 1 to 12. Invest $300,000 to open your first franchise location. Choose something proven with strong unit economics. Fast casual restaurant, fitness center, automotive service, senior care, children's education. Spend the first year learning the system, optimizing operations, and proving you can run a profitable unit. Phase 2. Replication. Months 13 to 24. Once you've proven the model works, use another $300,000 to open locations 2 and 3. Now you have 3 operating units. Economies of scale in purchasing and operations. Ability to hire a general manager for location 1 while you oversee all 3. Proof to franchisors and lenders that you're a serious operator. Phase 3, leverage and scale, year 3 plus. With 3 profitable locations, you can get financing from the franchisor or banks. They love multi-unit franchisees. Use remaining $400,000 plus financing to open locations 4, 5, and 6. Hire a regional manager to oversee operations. Step back into a true ownership role. Phase 4, empire status, years 5 to 10. By year 5 to 7, you could own 10 to 15 franchise units generating $200,000 to $500,000 per unit in revenue, 10 to 15% profit margins, total annual profit, $300,000 to $1,125,000. You've transitioned from operator to business owner. You're not working in the business, you're working on the business. The exit, franchise empires sell. For 3 to 5 times annual profit. If you're netting $750,000 annually from your 12 locations, you could sell for $2.25 to $3.75 million. Or keep it, continue collecting profits, and potentially expand to 20, 30, 50 plus locations over time. Some franchise owners have 100 plus units and make tens of millions annually. Real example, Flynn Restaurant Group started with 1 Applebee's franchise and now owns over 2,600 franchise restaurants across multiple brands, Applebee's, Taco Bell, Panera, etc. They're one of the largest franchise operators in America. Your $1 million is the seed capital to potentially build something similar, though obviously on a smaller scale initially. Chapter 40, the royalty and intellectual property play. Here's a strategy most people never consider. Buying existing income-producing intellectual property. Music royalties. There are marketplaces where you can buy portions of music catalogs that generate royalty income. With $200,000 to $500,000, you could buy a percentage of popular songs that generate streaming royalties, rights to older music catalogs, publishing rights to hit songs. These generate monthly income from streaming services, Spotify, Apple Music, etc., radio play, TV and movie licensing, cover versions by other artists, international rights. A well-chosen music catalog can generate 5 to 8% annual returns through royalty payments, plus the potential for appreciation if songs become more popular or get featured in major media. Book royalties. You can buy rights to existing books that generate ongoing royalty income. Romance novels, genre fiction, technical manuals, and educational books often have steady sales. Invest $100,000 to $300,000 in acquiring rights to a catalog of books generating steady Amazon Kindle, audiobook, and print sales. Patent licensing. This is more complex, but potentially very lucrative. Buying patents and licensing them to companies that want to use the technology. With $300,000 to $500,000, you could acquire patents for useful technologies and set up licensing agreements that generate ongoing income. Website and digital asset acquisitions. There are entire marketplaces, Flippa, Empire Flippers, FE International, where profitable websites and digital businesses sell. With your $1 million, you could buy established e-commerce stores generating $50,000 to $200,000 annually, content websites with advertising income, SaaS businesses with recurring revenue, mobile apps with user bases and revenue. These typically sell for 2 to 4 times annual profit. Buy a business earning $100,000 per year for $300,000, run it, or hire someone to run it, collect the income, potentially grow it, then sell it later for more than you paid. The portfolio approach: don't put all your money into one type of IP. Build a diversified portfolio. $200,000 in music royalties, $200,000 in website acquisitions, $200,000 in book rights, $200,000 in patent licensing, $200,000. Reserve and operating capital. Each asset class generates income streams. Combined, you might be earning $60,000 to $120,000 annually in royalty and IP income, all relatively passive. Plus, these assets often appreciate. That website you bought for $300,000 might be worth $500,000 in 5 years if you've grown it. The music catalog might increase in value if the artists become more popular. You're generating current income while building long-term wealth through asset appreciation. Conclusion. So what can you actually do with $1 million? The answer is almost anything, but not everything. You can buy financial freedom if you're smart and patient, investing in a diversified portfolio of assets that generate passive income while appreciating over time. You can turn that million into multiple millions through strategic real estate, business ownership, or market investments. You can buy incredible experiences traveling the world, making memories, living life on your terms for years or even decades if you're budget conscious. You can buy security for your family, funding educations, paying off debts, creating a safety net that provides peace of mind. You can buy impact, making a real difference in the world through charitable giving or impact investing. But you can't buy all of these things at once. You have to choose. You have to prioritize. You have to understand that $1 million, while significant, is not infinite money. The people who successfully leverage $1 million into lasting wealth and happiness are the ones who, 1. Have a clear plan. They know what they're trying to achieve and why. 2. Resist impulses. They don't make emotional decisions with their money. 3. Diversify. They spread risk across multiple asset classes and strategies. 4. Keep learning. They invest in their financial education and adapt over time. 5. Think long term. They're building generational wealth, not just funding next year's. Vacation 6. Stay grounded. They don't let money change who they are or inflate their lifestyle unsustainably. 7. Give back. They use some of their wealth to make a positive impact. $1 million is a tool. Like any tool, its value depends entirely on how you use it. Use it wisely, and it can fund a life of freedom, purpose, and impact. Use it foolishly, and it'll be gone before you know it, leaving you with nothing but expensive lessons and regrets. The choice, as they say, is yours. So if you ever find yourself with $1 million, whether through hard work, luck, inheritance, or hitting the lottery, take a breath. Take your time, think it through, and then build something that lasts. Because that's what $1 million can really buy, the opportunity to build the life you've always wanted if you're smart enough to seize it. Now go out there and make it happen.